and gentlemen, good day and welcome to the GE Power India Limited earnings conference call for the first quarter of FY2023-24. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star and then 0 on your telephone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Prashant Jain, Managing Director, GE Power India Limited. Thank you, and over to you, sir.
Thank you, and a very good evening and warm welcome to you all for joining this discussion on the financial and operational performance for the first quarter of financial year 2023-24. Before we dive into the quarterly performance, I would like to welcome my team who is joining me today in answering questions, clarifications. I have with me Mr. Yogesh Gupta, the Whole-Time Director and CFO, Mr. Vineet Pant, Chief Commercial Officer, Mr. Raj Raman, Executive Project Portfolio on the call. We will start with the global economy outlook, where there was optimism which has made notable return to the global trade and markets in recent months, bolstered by improved investor sentiment projected for 2023. As energy prices stabilize and major economies witness a steadying of inflation, businesses are increasingly positive about growth prospects for the current year and beyond. The correction in commodity prices, including energy, has been a significant trend, and this includes a return to pre-Russia-Ukraine war levels. While the global energy crisis is gradually waned, renewed attention is now being directed towards the transition to clean energy solutions. Despite the emphasis on expanding renewable energy capacity, utilization of coal has reached a new peak in 2022. This upward trend is anticipated to persist throughout 2023, as indicated by IEA. Notably, IEA's latest report indicates that any slight reductions in coal power generation during 23 and 24 are expected to be counterbalanced by increased utilization of coal. The report further underscores that predominant surge in coal consumption will be driven by China, India, and Southeast Asian nations. Collectively, these regions are taking into account for a substantial portion of global coal consumption in 2023, with approximately 3/4 of total coal consumption worldwide expected to happen in these geographies. Shifting focus to India, the period of April to June 23 witnessed a slight 1.8% year-on-year increase in power consumption, reaching 408 billion units, according to data from Central Electricity Authority. The growth rate remained modest, primarily attributed to the impacts of the Biparjoy cyclone and unexpected rainfall. Notably, coal production experienced a robust expansion of 8.5%, reaching 233 million tons during this quarter. Conversely, coal imports saw a decline of 13%, totaling 14.2 million tons. A significant development emerged recently with the government's clarification in the Rajya Sabha yesterday. It was affirmed that the government neither has intention nor has devised a plan to phase out aging coal-based power plants in the country prior to 2030. This decision aligns with the foreseen energy demand landscape and the anticipated capacity augmentation in the years to come. This government's clarification presents a pivotal opportunity for your company's services catering to coal-powered thermal plants. The extension of the deadline for flue gas desulfurization, or FGDs, has resulted in dampened order backlog and delays in ordering cycle, consequently elongating the timeline for the company to revitalize its operations. Speaking about the company's performance, in the first quarter of the financial year 2024, we are continuing to see that the turnaround is taking longer than anticipated. We are seeing a slight improvement on the FGD market, but conversion to orders is still slower than anticipated. Also, for service upgrades, we are seeing a slight swing, but orders are not yet able to fulfill the gaps that we have from the SBD and new build. Our strategy to focus on core services growth continues to pay. We had an excellent quarter with orders up by 57% quarter-on-quarter, and our performance in core service execution has also been solid with high productivity. We will continue our efforts on core services over the quarters to come. Our revenue is down 14% versus first quarter prior year due to lower orders in the previous quarters and project delays. Our efforts on claim settlements are ongoing with the customers. It is a long drawn and time-consuming procedure while we are representing to the ministry and the respective customer organizations. The JEPIL organization is currently structured to the optimum size to execute existing backlog and with new projects while keeping costs under control. Now, for discussing the financial operations, I will call upon our CFO, Mr. Yogesh Gupta, after which we will open the forum for question and answers. Yogesh, thank you.
Thank you, Prashant. Good evening, everyone. I am pleased to welcome you all to discuss the financial and operational performance for the first quarter of FY2023 and 24. Lower than expected new build industry demand has resulted into lower order inflow in the last 2 years. This has continued to impact our revenue and margin for the quarter ended 30th June 23. During the quarter, the company got orders worth 191 crores against orders of 1,008 crores in the quarter one of FY22-23. This in the order intake was primarily on account of quantity order of 850 crores of pump storage that we had booked in Q1 of FY23. As of June 30th, 23, we have order backlog of 3,382 crores, which represents active revenue opportunities in hydro, FGD, boilers, and service segment. Revenue for Q1 24 stood at 424 crores, down from 491 crores in the corresponding quarter of last year. Whereas the revenue in Q1 of 23 is if we compare with Q4 23, it was only 332 crores. Loss before tax for quarter ended 30th June 23-24 was 136 crores against loss before tax for quarter 1 of 22-23 of rupees 63 crores and a loss of rupees 188 crores in Q4 23. The increase in loss before tax for quarter 1 23 as compared to the previous quarter 22-23 is due to one-time provision impact of NTPC super fire incident, which required a provision of 69 crores Q1 24. Lower volumes, under liquidation, lower capacity utilization, delays, inflation, and execution challenges at sites impacted the financial performance. Loss before tax for the quarter ending June 23 is mainly due to the following: impact on account of lower volumes, delays, and inflation, etc. Whereas the super fire incident, which impacted us by 69 crores, of which 20% is likely to be recovered from the insurance company. Summarizing, focus areas for the company continue to be volume increase, where fresh order intake, claim settlement, and cash collections. Now we are open for the forum for the Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Viraj Mahadevia, an individual investor. Go ahead.
Hi, sir. Question regarding this loss due to fire of 69 crores. Where exactly is it built into the line items in your P&L for the June quarter? Hello?
Yes, I got your question. You're saying where is it represented in the June quarter, Suresh?
Yeah. This has been accounted for in cost of material.
Right. Okay. That's why you're seeing escalation in cost of materials.
Very much.
So in the absence of that...
From 76%, it has increased to 90% because of this.
Right. Okay. That was my next question. But okay, so in the absence of that, actually your net loss would have been half, right? About 65 crores.
Yes.
So your net loss has actually come down, which would mean an negative EPS of 10. Okay, that's helpful. So my second question, sir, is to Mr. Jain, the MD. Is your spread between your total income and cost of materials, even stripping out for this one-time loss, is less than or equal to just your employee costs? So fundamentally, something needs to give in the business to turn around, right? I mean, one is the revenue side and the FPD business coming in. Two is right-sizing the cost structure of the business. It clearly seems lopsided. I need to get your view on that.
So the current cost structure is optimized to the extent that we have, let me see the way we have currently to execute the backlog of the projects and recover cash from the existing projects. Mm-hmm. So therefore, the optimization in terms of the structure has been done with restructuring to retain competence. For example, in Durgapur, we have reduced the capacity from 800,000 hours progressively in the previous quarter and down to about 180,000 hours. Today, the load in the first half is about 52,000 hours in the factory, and there is an underutilization. But the factory is geared up to take growth, and it is not meaningful anymore to downsize it from any further. And therefore, there is an under-liquidation from the side that is contributing to, as a part of the cost. So the balance that we are currently trying to strike is to retain competence both in FGD and the Durgapur factory, while we are waiting for these orders to revive and we get the revenue back on the books. And therefore, I mentioned that it is taking longer to turn around the company because we need the volume and the nature and the scale of the order intake. For example, FGD, it takes at least 6 to 8 months of engineering, and then supplies meaningfully start around 12 to 15 months. And even if you book an order in the current quarter, the one that we announced, Sika, that will be at least 15 minutes away before we can bring that to revenue. So that is the challenge that we are currently balancing in terms of retaining competence to be able to gear up for the opportunities that we see around the corner. At the same time, executing the backlog, which is itself very complex, and there is a lot of cash and working capital that will be released with the execution of this backlog.
Understood, sir. But presumably you've looked at contract versus full-time labor on your book.
Yes, this is the biggest focus, and we have exhausted those levers. If you've seen the last 3 years, we have been extremely proactive on right-sizing quarter-on-quarter.
Right.
And the question is, if the biggest issue that we have faced in the current year is the delay of the timeline by 2 years.
Are you seeing greater traction on the FGD? I read your commentary, but are you seeing meaningful business coming this way? Who are your competitors? Is it just the L&Ts of the world? Is it limited competition? What is the potential market of this FGD in terms of addressable opportunity, and then how much do you think you can address over the next 2 to 3 years?
Yeah. So Vineet, would you address this question? In summary, yes, we have seen traction. We have seen traction. We have disclosed the order that we have taken from Gujarat Sika in the current month. We will be probably booking that order in this quarter. And the other opportunities in the pipeline will materialize. Before Vineet addresses the other questions on this, so I just wanted to come back to the point that unfortunately, though we will book these orders, the delay of practically almost 2 years in these orders coming into the books will still continue to impact us for the coming quarters by the time we start seeing meaningful revenue coming from them. So, Vineet, over to you or to explain the market-related questions.
Yeah. So on the market, we see 21-22 was, it was only 8.5 gigawatt.
Sorry, I'm losing you. I can't hear you, Vineet.
So,
sorry to interrupt. May I request you to please rejoin the queue?
Can you hear me now?
Ladies
Hello?
and gentlemen, if you wish to ask a question, please press star and 1.
Vineet, go ahead.
So, answer to your question, 21 was a bad for APS. But after that, we have seen a gradual in the order intake, order placements. So this year, so if we about what will be, even though been
sorry to interrupt, but the line for you is not very clear. It's breaking up in between.
okay, I will talk. Is it better now?
This is slightly better, sir.
Yeah. So what I was trying to say is that, in 2023, we saw about 50 gigawatt orders, which has, this year we expect around 18 gigawatt will still be ordered. And, there has been a delay, which has been in the implementation timeline. So we really expect the ordering to pick up in the next 2 quarters. So that is about it. And as far as our market share is concerned, we are going to focus on cash accretive deals. We really don't want to go after all orders. We will be selective, and we were still looking at the overall market. About 114 gigawatt still needs to be ordered. So definitely we see a lot of prospects going forward. Yeah, there is a delay, but I think it's going to pick up in the next 2 to 3 quarters.
Thank you. The next question is from the line of Ramakrishna V, an individual investor. Please go ahead.
Good evening, sir. Thanks for the opportunity. So last call you were mentioned that you will become a debt-free company, and there is, I think, you have a receivables of 1,900 crores or something. So what is the progress on that?
So yes, we are on a track to be able to collect retentions that we mentioned in the previous call. Yogesh, you want to mention about that?
Yes, please. We had indicated that we will be collecting about 1,300 crores the current financial year from our retention and accounts receivable, and we are very much on track. And if we look at the collections in the first quarter, they are very much proportionate to what we have indicated. We have collected 350 crores from our receivables and retention, and we are focusing on this. And this lot of share has set us back, and we are reevaluating what will be the position on the company. So we are very much on track on what we indicated in the last call collection front.
Once you collect the full money, then you will become a cash positive company. You should have a 400-500 crore cash, or it will be a...
We are still evaluating that.
Yeah, we will update the progress quarterly. We are in a very dynamic situation, and we will update that as we.
Sir, can you throw light on the idle opportunity for you, sir? There's a big opportunity.
Yeah, so in the pumped hydro storage, we had the order from Saundatti last year, approximately in the same quarter. This order is currently under suspension due to land issues from the developer. The company is being selective in looking at the opportunities, focusing largely on the private customers. Kalpesh, you are on the call. Maybe you want to address this topic?
Okay. So, in addition to what Prashant mentioned, we follow the policy, and then in terms of the market, currently government is coming up with PSP policies and guidelines. So we see a positive development on that side, but we would like to see in terms of the order how it comes up in the market. So there will be a lag in terms of the orders that will come up in the market, because all the developers evaluate the policies and then they will form up their plan. So we will have to wait and watch how the orders comes up in the market.
So ultimately, that 3 years time, where you see that idle will be what percentage of the business? Like you have service, then FGD, then that idle.
Yeah, so the hydro is around 90%, 18% approximately of the revenue. And we don't anticipate that this will change significantly because normally the hydro projects are long gestation. And as you see, the book order that we booked last year is on suspension now due to land issues. So these are complex projects, they take time, and therefore we are very selective in the projects that we bid.
Thank you. The next question is from the line of Danesh Mistry from First Advisors. Please go ahead.
Hello. Hello.
You are audible, sir. Please go ahead.
Hello.
Sorry.
Yes, please.
You are audible.
Yes. Hello. Thank you for taking my question. Actually, I was just referring to the cash that you received this quarter of 350 crores. So that's coming from the existing receivable. But I just wanted to understand on the services side, how are we seeing the business pick up, especially, now because one side we got the Section 11 as well. So is that kind of impacting our service order intake, and do you think it will be more lumpy once things, settle on this Section 11 side? That was the first question. And
what is the Section 11 that you are referring to?
Electricity Act, which basically is to run the plant. So that's one. And the second one is the fact that, regarding your debt, net debt free, you mentioned that CPAT has impacted it. So is that to the extent only of 59 crores, or are we talking about something more? That's it. Thank you.
So first on the service market, we have two components in the service business. One is the core services, which is computer services, and that is consistently quarter-on-quarter we are reporting growth as per our strategy.
Okay.
The second component is upgrades, where yes, the Section 11 that you referred to, where the government has said that look, we should plan upgrades, but at the same time, because of the must-run situation, the outages need to be deferred. So that is impacting the upgrades and not the support services. However, we are seeing positive momentum on the upgrades, where we are seeing that, especially we have started to book orders in upgrades this year. Last 2 years, we have literally seen no orders in upgrades, but this year we are seeing upgrade orders coming back. Customers are planning for upgrades. The orders are still not meaningful enough. So in terms of lumpiness, the core service is where we are focusing that it should be as stable and consistent as possible, and that is on track. Grades will of course follow lumpiness as we see the projects unfold. On what kind of upgrade opportunities you are chasing, Vineet will add some color. Vineet, over to you.
Yeah, so on upgrades, we are working on DeNOx. NOx market is really picking up, as Prashant mentioned. So that implementation deadline is 2024. So we see a lot of seriousness. Earlier also we had opportunities, but they are converting into orders now. So the DeNOx is definitely there, and we are also looking at some of the customers. They are also going to trying to improve their availability, so they are going for the boiler upgrade. So these are the two sectors where we see growth. And then flexibility also is something which is customers have started asking us offers for. It's mainly for study now, doing the studies, but it is also going to pick up maybe in the next couple of years.
That is flexibility as a fuel flexibility, or
the turbine upgrade. The government is pushing for revamping, delay in the retirement of the older units. So that is also something which we have started working. We are seeing traction in the market.
Got it. Understood. Thank you. And on the question regarding the net debt, you said part you can, push that back a bit. So is it the extent of the 69 CR or is it a higher amount? And that we are seeing this.
Yeah, in terms of cash in, cash out, the impact is actually a bit double because we have to collect the cash. We will not be able to collect the cash on time. Plus, we will have to spend to repair and then collect that. So that is the impact that we will see.
Okay.
So that will be recovered from the insurance.
That can be recovered from the client, right? The cash provides the claim, I reckon, will come from the insurance company.
Yeah, but it will take time when we have to complete the work, collect cash, right? So we will have to first spend to rectify and then recover from the insurance and customer.
Got it. And when do you think this project will be complete for you to be able to recover the funds?
The current estimation is 6 to 8 months.
Okay.
And what we're still working on it. The challenge is very complex because it's certain components of a package which have been damaged. And the bill of quantity, it is a bit complex, but yes, the teams are working to resolve it. Make it 6 to 8 months.
Fair enough. And if I can ask one last question, I don't know if you'll be able to answer it or not, but your promoter about 18 months ago had given an interest to kind of exit the company. Do you know of
We lost you. Can you repeat, please?
Sorry. Your promoter about 18 months ago had said that they wanted to exit the company, GE. So any update on that? Any progress that you can share?
No, there is no update on that one.
Okay. All right. Thank you very much. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Viraj Mahadevia, an individual investor. Go ahead.
Hi, thank you for taking my question again. Just picking up from where I left off, one of the individuals mentioned there's a 114 gig opportunity. What does that translate to into rupee crores in terms of market size in FGD in the next couple of years? And what reasonably do we think we can garner off that market share?
Vineet, it is not next couple of years while Vineet is coming online. The opportunity will be spread since the government has not only delayed the implementation by 2 years, but they have also set up 3 zones in how the implementation to happen. So that will be spread over the next 5 to 7 years is our estimate. And the number in terms of gigawatt market share, we want to retain maybe about 10%. And in the volume, it will be lower. So, Vineet, are you online?
Yeah, I'm there. So I think it would be around maybe around 60,000 crores. That is
60,000 crore opportunity over a 5-year period.
That's the market share.
That is the total market corresponding to this one.
Understood. And what do we think we can garner based on who offers this product, competitive situation? Is it sort of 20%?
So we have currently, as I said, DHL, LMK, the 2 major players, and there are Chinese players in certain states who are now.
The Chinese won't get it, so it's
BHL. They are participating now via local partners, unfortunately.
Okay.
So, and we have a plan to stay in gigawatt terms at about 10%, but that will not translate to volume because we are not going to pick up EPC for all the projects. We might pick up EP. The way we see the market progressing is NTPC was all EPC, but as we see now the trend, customers are splitting packages and they are asking limited scope. The scope will not be a full EPC, it will be a part scope that we see will be ordered in the future. So in the gigawatt terms, maybe 10%, but in the value terms, it will be less than half of that.
Understood. So if I'm just doing this maths very quickly, 50,000 crore opportunity over 5 years is just for average sake, 12,000 crores annually. You're saying at best we are getting a 10% share of this in value.
No, not value, gigawatts. Value will be lower, as I said. We will not participate in the
even lower. So let's call it of 12,000 crores annually, if they're even saying 5%. Only a 600 crore opportunity. Not very large. How does that get you out of your current debt situation and this setup?
So yes, we are focusing on, as I said, we are currently focusing on 3 levers in the turnaround. One, of course, is to develop the services. and services is currently growing, core services in the range of 20%. And the second is to focus on industrial segment, which is an opportunity that we are focusing from. And the third one is to focus on the private customers, or again, in terms of opportunities that we see coming from industrial and others for Durgapur. So those are the three areas we are focusing currently on. And as we are able to come to stable operating size, we will be optimizing the organization further. So we will go through this transition in the next couple of years.
Okay, understood. You know, at 600 crore annual opportunity for yourselves, that's 150 a quarter. Even if you strip out for the loss prior this quarter, it barely brings you into the black at an EBIT level. So,
I would like to add here, like we have hydro tickets also, which are like 14 that will be there. So it will be also reasonably, I would say, a decent value.
Right. Okay. So there is some other opportunity also.
Yes, please.
Okay. Thank you. All the very best.
Thank you.
Plus, we have the fog as well, which will be making us in good stead at least for the time.
Thank you. The next question is from the line of Murthy Valura, an individual investor. Please go ahead.
Yes, sir. I have a question regarding this hydro market. Now the pump storage market is evolving, and how good are we to capture that market? Hello?
Yeah, we
Hello.
will add, but currently we do not participate directly with the market. We work with developers. And as a part of the strategy, we are going to focus with private developers for the opportunity, and we will be selective in the opportunity where it is market accretive and cash accretive. And the terms and conditions are fairly low risk. So that is what we will see, because these are all projects which require land clearances, etc. And that is where we need to be careful in selecting.
So right now, the bids for electrical and mechanical equipment, right now bids are not coming.
Sorry?
Right now, E&M bids are not coming from hydropower side, pumped storage.
They are, but as we said, Kalpesh will add further to that. But as I said, we will be selective in this opportunity. Maybe Kalpesh, you want to repeat what you mentioned regarding the hydro opportunities?
Yeah, sure, Prashant. So, as you highlighted that there is a currently market evolving on the pumped storage, but still in terms of market development, it is still at a very initial stage. The developers are evaluating their proposals, and then they need time to form up their investment. So it takes them some time, and then we are yet to see coming up in terms of this new guidelines. So we will have to wait and watch how it comes up in the market. For sure, there are some positive developments on government side, but we will have to see how it translates into the order.
But, you know, actually the hydro equipment is manufactured at Vadodara factory. Now I think
the factory was closed. Yeah, sorry.
It was closed in August 2018.
It has been sold off?
It was shut down. The land was sold, yes, but the factory was closed. Yeah.
Okay. Now then, where do you manufacture this hydro equipment?
No, this is being outsourced to suppliers. We don't produce it anymore in India.
And we don't have any plans to make this equipment, hydro equipment?
It's too immature because for a factory we need a sustained growth.
Sunandaji, you have written that all the equipment will be manufactured in our plant.
No. I think no. Kalpesh, you want to clarify?
Yeah. Currently, there is no proposal for us to consider the factory manufacturing. We received Sonpati, but as I mentioned, it's just one order. We will have to see how the new order comes in the future.
Thank you.
Thank you. The next question is from the line of Vivek Kumar from Best Branch Research and Advisory. Please go ahead.
Thanks for the opportunity. I'm new to the company. So my first question is on these FGD orders. You have receivables around 1,300 crore you are saying you will receive. So if you keep on winning these FGD orders, should we assume that this is the kind of receivables and retention money that will be stuck, and this is something that even though we say next year onwards again it may go into retention, or a different kind of order?
So yes, therefore we are being selective. As Vineet mentioned earlier, we will be selective. We will select customers where we think we can negotiate and maintain cash equities. So that is our objective. Therefore, we are not going for all the volume. We are being selective in margining cash equities, which we can convert largely to cash with a 32-month period.
So we receive this 1,300, so the whole thing will again go back to certain new projects, or it will be largely used to get into new projects?
No, the retention will be in the range of 5% in the new projects. The earlier projects had a larger retention. In the new projects, we are negotiating and maintaining that we will not take projects with high retention. That is our goal.
So the 1,300 crores, can we assume that it's part of your cash, at least 1,800 crores we can use it for? Can we assume that?
No, I think we are mixing up. The 1,300 crores is a cumulative of all the collection that we are getting for the past quarter.
So my question is, I understand 1,300 crores, let's say you receive by the end of this year, will it get back into receivables or retention again immediately in the next year, or it largely can be used for other purposes? That's my question. That's my understanding.
Yogesh?
Yeah, thank you, sir. So the money that we collect will be used for paying our payments and other expenses that we pay, and we will be using a central portion of that to repay the debt as well.
But maybe the new orders will not require such amount of reduction, right? That I can take it, right?
Yes, we are planning that the new orders will have a lower retention amount in the range of 10%, and unlike the NTPC projects which we are still executing, where the retentions were a lot higher, the new projects we are anticipating will have lower retentions. Here we are making sure that we don't take high retention jobs.
So second question is, sir, you have said that the services are different, and then hydro and you are talking about FGD. So are there any other opportunities over the next 2 years? What kind of growth do you think you will expect in terms of revenues, and when do you think you will post at least EBITDA profits in the next 3 years, or can you get on any other new things new opportunities that you may be considering in terms of exports, or these three are the things that you have to think on in the next 3 years?
Yeah, so we will, the current focus is on these three areas. We are evaluating certain additional opportunities, but it is premature at this point in time for us to be able to come back. But yes, we are consciously looking at certain opportunities. I mentioned a bit earlier, especially with the factory in Durgapur, we are exploring options to be able to produce for non-power related topics. We have received some success there. About 20 to 30,000 hours we have been able to bring for metals industry, fabrication, and we are looking at additional fabrication opportunities which are non-coal for the factory in Durgapur. So those opportunities are premature. We are working to get the factory qualified. Qualification process with EIL and all trade, which takes about 6 months to 1 year. So currently there are plans, yes. We are testing out markets, we are conducting certain studies, and it's premature, but yes, we are working to find a way to be able to fill back. But in our estimate, these measures will take at least 1.5 to 2 years for them to materialize. This is the reason why we have said it is taking longer than anticipated turnaround. Had the FGD orders been delayed, maybe that would have been sooner. Unfortunately, because of the delay in FGD orders, the time to bring the other additional opportunities and develop the new areas of business is going to take time. And we are focusing on certain ideas. I will share with you progress as we move forward.
So you will not be able to say when the revenue in the next 2 years, right? You are not giving any guidance. When I say guidance?
No, we don't. Yeah.
Sorry. So I am asking, this is all power companies. If you see there's worldwide, there's Atmanirbhar and power that is required, and there's a huge boom in terms of steam, maybe non-coal related steam and renewable transition. Which is a good opportunity. Are we right position, or this is something that we are not which will not give us, which is not for us? Because
no, we have mentioned, so we have mentioned two areas. One area is the integration of biomass, integration of ethanol into the existing coal-fired power plants is an opportunity that we are exploring and working. We have signed an MOU with NTPC, and we mentioned about that in the previous call. That is an area that we are working on. For that to meaningfully translate into some revenues, it will take about 2 years. Because these are exploratory, we will pilot, test it out, how it looks, what is the impact. The second area that we are working upon is flexibility. Again, flexibility, the orders that we are seeing currently in the market are the orders for study, where the customers are wanting to test in their system for the boiler, turbine generator and the auxiliary system, the auxiliary power, whether the system is stable at 50%, what are the changes that are required. Now these studies, when we do, that will then create opportunity. It is 6 months in terms of studies and then opportunity, and at the time then again approval process. So we expect flexibility will start into meaningful opportunity again in about approximately a year from now. So there is an interest, and we have seen that interest increasing.
can you throw more light on what this flexibility is, if you don't mind, because I'm new to the company?
So during the day when there is more solar or wind, the coal-fired stations have to come down to 40% of the rated capacity. Otherwise, and then in the evening when there is a peak demand, the coal stations have come back to full power. So in order to make this transition from full load to low load, coal stations are all designed to operate at 100% load. They are not designed to operate at variable loads. But because of the renewable integration on the grid, now the coal stations have to be more flexible. And that requires certain modifications in the plant. And those modifications is what we are talking about to ensure that these coal-fired power plants become flexible so that they can enable more renewable electricity to the grid.
Thank you. Ladies and gentlemen, if you wish to ask a question, you may please press star and 1. Participants, to ask a question, please press star and 1 at this time. To ask a question, ladies and gentlemen, you may press star and 1. If there are no further questions, I would now like to hand the conference over to Mr. Prashant Jain for closing comments. Over to you, sir.
Thank you all for joining and asking these questions, and thank you team for being with me. And we will talk to you soon. Thank you all. Have a good evening.
Thank you. On behalf of GE Power India Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.